Good day, everyone. I'm Nadeem Hussain. I'm a portfolio manager, and I'm bringing you the quarterly bulletin for the third quarter of 2025. Let's start off by looking at the markets and seeing what was been happening over the last quarter. Equity markets continue to surge once again. Global stock markets are pushing to record highs. The MSCI All Country World Index gained a solid 8% in quarter three in dollar terms and is up 18% year to date. The MSCI Emerging Market Index was also up 11% in dollar terms and is up a whopping 28% year to date. And this was led mostly by Chinese tech shares. Bond markets were volatile throughout the quarter as global political uncertainty and concerns around fiscal stability came into focus. The Bloomberg Global Aggregate Bond Index ended the quarter up 0.7%. Global equity markets in the US, the economy proved resilient with the final estimate of the second quarter GDP numbers better than expected at 3.8%. Tariffs had yet to push up inflation, but the impact could be profound on inflation. The S&P 500 has pushed to fresh new highs, fueled by investor optimism for rate cuts, solid corporate earnings, and ongoing AI euphoria, which was up in quarter three. Tariff negotiations between the US and the EU was finalized with a 15% tariff ceiling on most EU goods. The ECB kept interest rates unchanged in August at 2.15%, following 7 consecutive cuts. German inflation figures came out higher than expected for July, which could influence ECB policy. In China, the Chinese market was driven by higher by tech shares after the government announced to triple chip supply by 2026. A weaker yen supported exporters in the Japanese market. A US-Japan trade deal, which lowered US tariffs on almost all Japanese exports from 25% to 15%, combined with resilient domestic macro data and ongoing corporate government reforms, contributed to the performance of Japanese equities. In our local market, the US government introduced a 30% tariff on South African imports. However, minerals considered to be critical to the US, notably platinum group metals, gold, chrome, and coal, will attract 0% tariffs. That accounts for about half of what SA exports to the US. So excluding these commodities, it's a major relief. SA will really feel the pain in its exports of cars. Tariffs are now at 25% versus 0% previously. Steel and aluminium also had tariff hikes of up to 50%, which was previously 25% and 10% respectively. And agricultural products tariffs was up to 30% versus mostly duty-free before. The SARB kept borrowing costs unchanged at its last meeting in September after a 25 basis point cut in July, maintaining the benchmark interest rate at 7%. This after data showed inflation unexpectedly slowed to 3.3% in August from 3.5% a month prior. There have been chatter about the SARB moving to a 3% inflation target. However, the credibility of the SARB is important, and the target needs to be finalized with the National Treasury as soon as possible. Our local market hit a new record high in quarter three, with the JSE All Share Index gaining 12.8%, led by the resources sector, which was up a staggering 47%, with the big investment story this year being a surge in precious metals. Year to date, the JSE All Share Index gained 28.9%. It is, however, important to mention that the local rally is fueled by a narrow group of shares, with gold shares being the leading driver of the market. Turning to the bond markets, a softening to the annual use employment growth, paired with no surprises in inflation data, allowed the Fed to cut interest rates by another 25 basis points for the first time this year. The global bond market remains optimistic, with expectations of 2 additional cuts by the end of 2025. The European Central Bank maintained its policy rate at 2%, consistent with expectations. Although Eurozone inflation was revised slightly upwards, it still remains near the 2% target. Similarly, the Bank of England held its rate at 4%, aligned with market forecasts. Global bonds had a lackluster quarter, with the Barclays Global Multiverse index up only 0.7% in USD. Returns in rands was less impressive, with the index down 1.8% for the quarter. Locally, our all bond index gained 6.9% in the third quarter and is up 14% year to date. The bond rally has been supported by inflation that eased to a 5-year low and geopolitical noise that seems to have quieted down for now. Yields on SA benchmark bonds extended declines in quarter three, with the 10-year yield on the government bond ending the quarter 80 basis points lower at 9.1%. Money market assets gained 1.8% in the quarter and is up 5.7% for the year to date. Now, looking at INN8 Invest model portfolio review, overall performance, the income model has performed well over all periods, with our underlying managers favoring bonds, which has outperformed cash. The multi-asset low, medium, and high equity portfolios had a tough quarter relative to peers. The overweight exposure to global assets was a key detractor of performance for these portfolios as the rand continued to strengthen and SA equities outperformed. Contributing to performance for these models was the stock selections in SA equities and exposure to SA nominal bonds. A small allocation to SA property also aided performance. Overall, the portfolios are underweight cash and overweight bonds as our managers continue to see appealing yields. The flexible long-term capital growth model had a strong quarter, outperforming the peer group over all periods. The overweight in SA equity was a key driver in performance, as well as solid stock selection from our underlying managers. Relative to the inflation targets, all the portfolios have performed quite well, beating their respective hurdles. Looking at underlying manager contributions and the funds, Visio's unconstrained fixed interest fund, which we hold in the flexible income model, was a star performer over the past year. The rally in SA bonds supported this long duration strategy, and instrument selection was also very good. Amplify Strategic Income Fund, which we also hold in our flexible income model, delivered top quartile performance over the past 3 and 12 months. The fund's sizable allocation to SA nominal bonds and its more aggressive duration positioning were key drivers of performance, benefiting from the rally in local bonds. Exposure to floating rate credit was the second largest contributor, while holdings in local inflation-linked bonds also aided performance. Truffle Flexible Fund, which we hold in a stable growth, moderate growth, high growth, and flexible growth, has had an exceptional 12-month period. Stock selection in local equities were the performance drivers over this period. They've also been well weighted in the rally in gold and platinum shares, which further boosted performance. Coronation Balanced Defensive Fund, which we hold in our stable growth model, produced excellent returns over the past 12 months, with low cash and high equity exposures driving returns in a strongly rising market. The local equity returns were lackluster compared to the general equity market. However, a 3% exposure to commodities helped as the gold price continued to rally this year. Laurium's SA Flexible Fund, which we hold in our moderate growth, high growth, and flexible growth models, has been a standout performer over the short term. It benefited from good stock selection and a sizable allocation to gold and platinum shares, which contributed notably to performance over the last 3 and 12 months. The fund's sizable allocation to government bonds also aided performance. Looking at the funds that detracted from performance for the models, Presium's Income Provider Fund, which we hold in our flexible income and stable growth models. Although the fund was one of the lower returning funds in the solution, it had a reasonably good year. Initially, it benefited from healthy exposure to long duration bonds, which complemented its good instrument selection. They've consistently reduced the bond duration in 2025, which has hurt the performance more recently. Battlier SA Flexible Fund, which we hold in our stable growth, moderate growth, high growth, and flexible growth models, struggled over the last year, materially detracting from performance for the solutions. This relative underperformance was primarily due to the low allocation to the resources sector, specifically gold and platinum miner shares. 91's Diversified Income Fund, which we hold in our flexible income solution, was lagging over the past year due to its defensive positioning, which is in line with our expectations, as this period was characterized by risk-on appetite by investors. Its large exposure to floating rate notes, short-dated instruments detracted. Performance has improved recently due to its duration and instrument selection. 91 Cautious Managed Fund, which we hold in our moderate growth model, and the 91 Opportunity, which we hold in a high growth model, had similar performance drivers over the past 12 months, as it lagged its peers, with performance during the third quarter being particularly challenging. 91's overweight offshore allocation detracted from returns as local assets materially outperformed global assets. It's not been an ideal environment for the quality-based investment style as well, which particularly excels during heightened market volatility and drawdowns, which is a key reason why this manager is in our solutions. The 91 Global Franchise Feeder Fund, which we have in our flexible growth model, has also detracted from performance due to the quality-based investment style, detracting from performance there as well. Moving on to the outlook and looking forward into the fourth quarter, SA Equities has delivered exceptional returns year to date, mostly driven by a narrow group of stocks. Current valuations range from marginally undervalued to fair valued. The rand is trading close to fair value, and this is according to Standard Bank research, but remains volatile and is difficult to forecast. SA is expected to be removed from the FATF grey list, but new corruption revelations could derail this progress. Currently, 2 rate cuts is expected in the US by year end. The market has pretty much priced it in. Strong's earning growth continues to support the AI-related stocks. Volatility is expected, but the long-term outlook remains positive for the sector. The proposed changes to the SARB inflation targets is positive for bond yields, and we could see further reduction in yields there. Our portfolios are set up to take advantage of these scenarios. And that's it from my side. I hope to join you soon over the next quarter and looking forward to talking to you guys again.